You can feel it, can't you? This AI boom, it's got that bubble feeling, right? I mean, the valuations are just crazy, and it feels like money's just being passed around in a circle. But look, the real question here isn't if it's all gonna pop, it's what happens to us when it does. All right, so let's dive right in. Everyone's talking about the AI revolution and this amazing new era it's supposed to bring. But what if it's just a repeat of something we've already lived through? The analysis we're digging into today makes a pretty chilling case, suggesting that if this whole thing comes crashing down, the fallout could actually be way, way worse than what we saw in 2008.
So, why the dire prediction? Well, it really boils down to three huge vulnerabilities in our economy right now. Things that just weren't there, at least not like this, before the 2008 crash. Let's break them down one by one.
Okay, so the first big reason things are different this time around, well, it actually starts with us, with you and me, the public. See, more of our own personal wealth is on the line right now than at any point in history. Why? Because our exposure to the stock market is completely off the charts.
And just get a load of this number. A record-breaking 30% of all American household wealth is sitting in the stock market right now. Just let that sink in for a second. The financial well-being of millions and millions of families is basically riding on the daily ups and downs of the market. That's a level of risk we have never seen before. Now, to really put that 30% into perspective, just think back to 2008. That crisis felt absolutely catastrophic, right? Well, that wiped out 20% of U.S. household wealth. Today, we're starting from a point that's 10 percentage points higher. So if a similar crash were to happen now, well, it would hit people's savings way, way harder. And believe it or not, that staggering 30% number doesn't even tell the whole story. Not even close. It doesn't account for the billions, maybe even trillions of dollars that regular people have poured into super volatile stuff like crypto. In a big market downturn, all that money could just, poof, vanish overnight. That would just pour salt in the wound. Okay, so if a crash does hit, can't the government just step in and save the day like it did last time? Well, that's a great question, and it brings us to the second huge problem we're facing. The government's toolbox, its rescue kit, is looking pretty empty this time. Its power to spend its way out of a crisis is, well, it's seriously limited. And to understand why, we need to quickly touch on this idea called fiscal space. It's a simple concept, really. Just think of it as the government's financial breathing room. It's the ability to spend a ton of money in an emergency without totally freaking out investors or wrecking its own credit rating. And when you look at the numbers today versus back then, wow, they are just jaw-dropping. So before the 2008 crisis, U.S. debt was sitting at about 60% of GDP. Today, it's literally double that, 120%. And the annual deficit, it's jumped from about 1% of GDP to around 6%. So that financial breathing room we were just talking about, yeah, it's basically gone. So what's the bottom line here? It means the government's hands are kind of tied. They have way less firepower to fight a crisis. With debt this high and a deficit that's already huge, pulling off another massive bailout like the one in 2008, I mean, it would be incredibly tough, maybe even impossible. All right, on to our third reason. And honestly, this might be the most dangerous one of all. See, in all the years since 2008, this massive, unregulated financial world has been quietly growing in the shadows. It operates completely outside of the normal banking system, and more importantly, outside of all its safety nets. And these things are called shadow banks. Basically, they act like banks. They lend money, they manage assets. They do all the stuff banks do. But, and this is the huge but, they do it without any of the strict rules. And crucially, without the government's safety nets, like deposit insurance, that are there to protect your money in a normal bank. Look, the difference is really simple, but it's absolutely critical. Regulated banks, they have tons of oversight and those government backstops that keep risk under control. Shadow banks, they have none of that. Nothing. So if things go south, there's no one there to catch them when they fall. It really is the Wild West of finance. And you're probably wondering, how big is this shadow world? Well, the scale is just staggering. Let's just take one piece of it, what they call private credit. That alone is a $3 trillion industry. Yeah, you heard that right. $3 trillion. And get this, that sector has grown tenfold since 2008. It's kind of ironic, isn't it? In our rush to make the old banks safer after the last crisis, we accidentally helped create this new and maybe even bigger monster lurking in the shadows.
And all of this growth creates a terrifying new list of players that could be considered too big to fail. We're not just talking about the big Wall Street banks from 2008 anymore. No, today the list includes massive private credit funds, major crypto stablecoin issuers, even certain European banks that hold trillions in US dollars. If any one of these giants starts to wobble, the domino effect could be just massive.
So, okay, let's put all the pieces together. You've got the public, more financially exposed than ever. You've got a government with very little ammunition left to fight a crisis, and you've got this enormous, fragile shadow banking system. What happens when those three things collide? Well, you get the perfect storm, an overwhelming pressure for a bailout that could be bigger than anything we have ever seen.
It really could be a terrifying chain reaction. Imagine this. First, the AI bubble pops. Boom. That triggers a market crash. The crash then causes these shadow institutions, which are packed with risky investments, to start collapsing, and their failure suddenly threatens the entire global economy, which leads to this massive political pressure on the government to, you guessed it, step in and bail everybody out. So the bottom line is pretty simple. The line of people and companies knocking on the government's door asking for a rescue is going to be a lot longer this time around. It's going to go way beyond the traditional banks we were all worried about back in 2008.
And here's the real kicker, something you might not expect. The bailout list might not even stop at financial companies. There's real talk that the very AI companies at the center of this bubble could be labeled as essential for national security, which would make them candidates for a government bailout too.
But this leads to the ultimate problem, right? Every time the government steps in to bail out risky behavior, it creates something economists call moral hazard. It basically sends a signal to everyone. Go ahead, take huge risks. If you win, you keep all the money. If you lose, don't worry, the taxpayer will cover it. It's a classic heads I win, tails you lose situation. And all it does is encourage even crazier risks in the future.
And so that leaves us with one last really troubling question to think about. If the too big to fail club now includes everyone from private credit funds to AI firms, what's actually left? What part of our economy is even allowed to fail anymore?